Good day, and thank you for joining Tyler Duncan Realty Partners for our monthly podcast on this Friday, January 31st. My name is Chad Tyler. I'm here with my partner, Brian Duncan, also our colleague, Charles Shapiro. And in a minute, I'm going to have those guys say hi. But first, I want to let you know what we're going to cover today. So today, we're going to do a market wrap-up. We're going to look at 2024 and sort of where we ended up in 2024 with all the major asset classes. So we're going to cover residential, we're going to cover the office market, the industrial market, and the retail market. We're going to cover the Washington, D.C. and extended metropolitan area for each one of those segments, as well as the Denver and extended metropolitan area, which is our primary markets of focus. So, Brian, you want to say hi?
Hey, how is everyone today? Everything's great in Maryland. Hope is well where you're at.
Mr. Shapiro, you want to say hi?
Hey guys, you know something, I'm in Mexico right now, and it's always fun to look and see what the weather is in Colorado compared to here. Hope you're having fun.
Enjoy your stay for the next few weeks in Mexico there, Charles. So Brian's going to start us off today. He's going to cover the residential market for the Washington, D.C. And extended metropolitan area. So Brian, go ahead and pick it up.
Well, thanks, Chad. Hey, it was an interesting last couple of years. We started out a little slow in 2024, and then second, third quarter picked up, and then the fourth quarter, kind of really sets a new standard for like where DC, Maryland will be. And if you notice that sales, in 2024, you get a mixed market. DC is a big marketplace. Okay. If we think about DC and as of itself, wow, what a great year. It surged by 7.7%. However, Maryland had four impacts that didn't seem to impact DC as much, and therefore their sales, decreased. Well, not decreased, but didn't increase as much as we thought. It only increased by 1.4. Those factors were pricing, still had been a little bit too aggressive by the sellers. The second reason, interest rates were a little high and impactful. Availability was still an issue in Maryland. And then the fourth one, Maryland had a terrible year for job growth. Okay, DC, Northern Virginia still had outstanding job growth, but Maryland, it really did impact sales. Then, as of December 24, we had prices, I guess, increased by 5.8%. Now that's an annualized rate. Okay. What we saw in the last quarter in Maryland was a reduction, or as we now call it, a price enhancement. Doesn't it sound better than reduction in pricing? But the sales pace for 2024, the inventory level resulted in an average of 1.6 months versus 1.9 months, which is a little surprising. But what do you think about it, though? What seller in Maryland wanted to sell who had a great interest rate somewhere between 2 and 4%, right? And then would want to move to another house where their interest rate was going to be 6 to 7%. So that's what impacted the inventory issue. We expect to see a better inventory this next year. In fact, this slide is really telling. What it tells you is the impacts represent both the cautious builders and their investors, okay? And that in and of itself impacted availability. Now, however, there's a second reason. We have an issue with buildable lots, okay, throughout the East Coast. Even Montgomery County, Maryland is now recognizing that and instituted a new study this past month about how they can impact and increase housing starts. While their focus has always been on workforce housing, they're finding that even workforce housing prices are increasing too much to make an impact for a family. So let's go to the next slide to talk about something I'm really passionate about right now is multifamily. Well, the vacancy rates increased slightly from 23 to 24. Not really surprising because, pricing has gone up, inflation's gone up, so there's less money to spend on rent. People were, instead of stepping up to a new rental property, they're plateauing for right now. Now, there's a new segment in multifamily. The builders created this. because of interest rates and their cautiousness, they've decided to create a segment that we've never seen here in Maryland, DC. It's called townhouse rentals. Now, we're not talking about onesie twosies. We're talking about an entire development or a segment of a mixed use development that is being rented out as townhouses. So it appears that you own your townhouse, et cetera, et cetera. You even have the option to buy your townhouse while you rent it. Okay. It's a new segment, very fast growing segment. Now, however, the median rent or lease rate in DC is, at $2,000. It's just the median rate. In the more desirable areas of Maryland and DC, okay, we all know that it's significantly higher than that. Okay. And builders are now recognizing that and trying to find ways to impact it and bring those rates down a little bit. Now, we always say, we'd like to talk about how positive 2025 is, and we expect some real positive reactions, but I never wanted to be an economist like Chad Tyler when I was growing up. So, we expect the DC and metro areas to see faster increase in sales activity, especially compared to the last quarter of 2024. What's interesting is we expect steady growth, okay, maybe even as much as 14% in 2025 over 2024. We think, there was apparently an election last year, at the end of the year. Somebody mentioned it to me recently. And we saw some people actually being hesitant about moving in 2024, the last quarter. So that's an old traditional thought process that came back. In addition to that, more inventory brings slower price increases. We expect to see pricing increase. However, we don't expect it to see as much as those heyday years. I think we'd all be happy with 4% increases. Also impacting that are the assessment rates that you see that just recently came out in places like Maryland and Northern Virginia. Everyone's property is being assessed at a much higher rate. So we have that we haven't factored in yet for this 4% increase.
Go ahead, Mr.
Say something, Chad?
No, go ahead.
All right. So then what's really interesting about multifamily deliveries, if we go to the next slide, I'm sorry, I should have mentioned that, is that they're going to decline. Now, they're going to decline in certain segments. And that's partially, again, now maybe a fatigue from investors, maybe an oversaturation, and the lack of permits. Okay. So there's factors to that. However, the largest, more urban areas are going to see that impact. Some of the suburban areas that are still building multifamily, okay, will find that you're going to see more product on the market, and they'll catch up to those impacts. However, DC is still very strong. Just because it's declining, it doesn't mean that there's not new units coming on the market by any stretch of the imagination. Supporting factors include strong job growth, population growth. None of us can predict what's going to happen with the new administration. How does bringing people back to work impact it, if it does at all? Every community's had a exodus of a major employer in this area. And then those housing stocks have all been saturated by new employers, biotech, AI, now data centers. So, well, again, I never wanted to be an economist like Chad did. I always feel that there's other factors, that we're looking at the positive glasses, half full, maybe even 3/4 for the next market. I will say, for the one thing that's going to be an interesting impact is that we do not know what the impact of insurance rates are going to do on the condo and apartment multifamily market. They've already started to creep up by 20-35% for condominium and apartment complexes that we manage. Chad can tell you that for a fact. But we don't know how that's going to impact the developers of that. Are they willing to take on that risk? And does that price them out of what their intended market delivery and investment return on investment is going to allow them? So I'm sorry for rambling on there a little bit but I think insurance is really important at this point.
Now, that's a great synopsis, Brian, of the Washington, D.C. and extended metropolitan area of the residential market. Also, what we're expecting for 2025. Charles, what questions do we have for Brian on that?
Information does
Go ahead, Charles.
Oh, can you hear me?
Yeah,
Hey,
but
Charles.
speak a little louder, please.
What information, you said the prices in Maryland were up 5.8% over the in 2024. What does that tell you about the market when you're saying that job growth has been slower in Maryland than in other jurisdictions?
So, so there were less than thousands of new jobs created in Maryland last year. And so what's interesting to that and how it impacts housing availability, housing stock, pricing increases, it always, it's a drag. Job growth or job creation is very important to the housing market. I'm not sure that you can point to one thing as to why job growth was stagnant in Maryland. I'm not sure that we can figure it out to improve it this year with unknown impacts by the federal budget. That's going to be impactful. We hear rumors of what the new administration wants to do, but in actuality, we don't know how that's going to impact job growth. We will tell you that some of the growing segments slowed down a little bit. Biotech, as an example, did slow down quite a bit. Okay. Service industry slowed down quite a bit. There was less construction work, obviously, for obvious reasons. The permits are down. Those are the three segments that impacted it.
Great.
So Brian, you mentioned the federal budget, and I know that there's been some talk about reducing the federal workforce, but I guess you think it's probably a little bit premature to try and speculate on how that might impact the housing market.
Well, what's always interesting to me is that, especially in this market, this region being so successful, is there's so many opportunities. AI being one, nationwide, international. Okay, data center job creation. Look at the data centers that are proposed in this region. Okay, it's the job growth, the construction jobs to begin with, well-paying. The investors want to be in this region. Okay, that's been proven by Northern Virginia, where one of Chad's sister companies has done a lot of work for the AOLs, Quest, Roadrunners of the world, building these data centers at Knox. It will continue, except for even at a higher exponential rate. Now that could, let's say federal government employees exit. Will they go to a private sector version to provide the services that they no longer provide at the Fed? Or will they be absorbed into these new data center employment opportunities? So It is a little early to figure out. I don't think the panic is on as much as some people try to make it out to be. I think you just have to be quick to react.
Yep. All right, that's great feedback and a great overview of the market. We're going to switch gears, talk about the Denver residential market. So Denver, over this past year, Denver has been historically a very strong market the last several years, but this past year it's not actually in the top 20 performing markets. While it's not in the top 20 performing markets, it did in fact actually still exceed some national trends overall, beat several national trends with other major markets. So some key highlights of the Denver market: we saw a surge in inventory towards the latter part of the year. In December of 2024, we saw an actual year over year, saw a 12.6% increase in listings year over year as compared to 2023. And single family homes, in fact, detached single family homes led a large part of that. And despite the rising interest rates that we've all seen and somewhat of a slowing economy, we still saw some decent increase in the level of transactions. Overall, in round numbers, we saw about a 1% increase in the level of transactions, the number of transactions, where overall nationally it was forecasted to be down by 5 to 10%. So Denver beat that expectation or that prediction. And also in the Denver extended metropolitan market, we saw an overall price increase 2024 over 2023 of about 2.8%. And right now that puts the median price in the Denver and extended metropolitan area for single family homes at $590,000. During 2024, we saw longer times on the market as compared to 2023. We saw an average time on the market of about 38 days, which was up moderately over 2023. So looking at 2025 in terms of the single family home market for Denver, for prices, we're expecting an increase of about 3 to 4% annually throughout 2025. In addition to that, as I mentioned earlier, the year end or going into 2025, we saw a median home price at $590,000. They're expecting that to tick up some along with the price increase there in 2025. In the immediate near term, maybe the first quarter, it'll probably be a little bit of a dip in prices, and then those will accelerate back up to achieve that overall annual growth rate. In terms of inventory levels, we're expecting to see continued increases in inventory into 2025. This will give buyers more choices in the marketplace. It'll also moderate the price growth rates that we talked about. So just as an example, right now in January of 2025, we're seeing inventory 46% higher than January of 2023. So quite a bit higher in terms of inventory levels. We also expect transactions in 2025 to be, in terms of the number of transactions, higher than what we've seen in 2024. Other factors that will influence the market in the Denver extended metropolitan area in a positive way are continued population growth, a lot of migration from folks outside of the state coming into the area. Right now, we know the Fed just did not change interest rates this week. So it's expected interest rates will stay stable. While they're a little bit higher than they have been the last few years, I think the stability will help bring more buyers into the market. And overall, the job market in the Denver area is decent, and the economy is fairly decent as well. So beyond those factors, just from a technology standpoint, as many of you know, technology is playing a bigger role in the marketplace today. So we expect to see more use of virtual tours, more digital transactions occurring, and more AI-driven analytics will continue to play a role within the home buying and selling process. So with that, I want to talk a little bit about the new home sales market. So with the new home sales market in the Denver and extended metropolitan area, we saw similar dynamics to the resale market. So we saw modest price increases throughout the year. We saw inventory levels tick up some as well. And as we're looking at 2025, a lot of industry participants are expecting those metrics to improve. Some expect as much as about a 13+% increase in the number of sales. We think that's a little too aggressive. Probably half that number makes more sense from our perspective. In addition to that, it's expected there'll be like 3 to 4% increases in the prices of new homes, and we think that makes sense. Switching gears, talking about the multifamily market, this graph right here is a chart put out by the Federal Reserve, and this tracks the new homes brought to market in the Denver metropolitan area over the last 5 or so years. So you can see kind of ending up right around the end of 2024. We're seeing an uptick, but looking back, like let's say 5 years ago, 3, 4, 5 years ago, down a fair amount from what we've seen from a long-term perspective. Switching gears and talking about the multifamily market for the Denver and extended metropolitan area. In 2024, for the multifamily market, predominantly apartments, we saw a huge amount of inventory brought to the market. So that has contributed to vacancy rates ticking up. And as we move into 2025, we're expecting that level of inventory. We know for certain that level of inventory is going to drop off considerably, both because of the excess supply, but also because elevated financing costs and elevated construction costs are making these projects not pencil out, financially speaking, and so they're not being brought to the market. So we mentioned the slow rent growth, elevated vacancy rates, and those other factors are contributing to less inventory coming to the market. So right now, the vacancy rate for Denver is at a record high for the multifamily sector, 10.9%. And as a result of that higher vacancy rate, we're seeing landlords offering significant concessions, predominantly in the way of a few months of free rent in order to attract renters. It's a pretty competitive market there. Right now, we're looking at average rental rates for a single-family apartment of around $1,800 a month, and then for the 2 bedrooms, an average rental rate of about $2,550 a month. And we're expecting rents, like right now, year over year at the present time, rents are down by about 2% from where they were for the prior year. So, Charles, before we move into the Washington, D.C. office market, any thoughts or comments, questions about the Denver residential market, that being your backyard? Ryan, did we lose Charles?
I muted myself. Okay. I have an observation and a question. The observation is that the multifamily market seems to react to supply-demand issues very, very quickly. So it's really interesting to see how rents go up and down very, very quickly based on what's happening in the market, because these apartment owners know what income they need for their projects and what rents they need to get there, what occupancies they need. So I always found that really fascinating, how quickly they respond. The question I have actually for both of you is, do we think that home buyers have found a new normal? That interest rates were low, they were buying, interest rates went up, they stopped. And have they gotten to the point where they say, okay, this is where interest rates are going to be for a while. They may go down a little bit, but they found a new normal. Do you think we're there?
Sure, Chad, if you don't
Go
mind.
ahead, Brian. Brian, why don't you speak to that?
Sure, that's a great question. What's interesting is 7% interest rate over the last 200 years in the U.S. is the average interest rate. I remember when I bought my first house in the late 80s, it was 11.25, and everybody goes, how do you get it so cheap? Okay, so what's also interesting is many of the lenders are marketing a product that allows you to then refinance in 2 years at no cost. So they're betting, as well as the buyers, that interest rates will go down, maybe not this quarter, next quarter, but in 2 years, certainly. And then they can reap that reduction and not have any additional closing costs. So I think people are getting accustomed to it. The industry is getting accustomed to it. I will say that the mortgage industry itself has already made some right sizing on employment, and that's declining because of the sales as well as the refinancing.
Good. Thank you, guys.
Good points. So we're going to switch gears, jump back to the Washington, D.C. and extended metropolitan area market. We're going to talk about the office market, and I will start us off with that. So over the course of 2024, we saw negative net absorption of 3.6 million square feet. So 3.6 million square feet came back to the market. And, despite the fact that we've had some return to the office mandates as far as employees, both at the federal level as well as the private sector level, it's not had a significant positive impact on the market. And even despite those mandates, office employment really is slowing right now. Office employment is slowing. So the vacancy rate at the end of 2024 going into 2025 for the Washington, D.C. extended metropolitan area is at 17.1%. It's an all-time high. In addition to that, the availability rate is at 19.9%, call it 20%. And we've talked about this before in other podcasts, but just as a matter of clarification, the difference there between the availability and the vacancy rate is that the availability rate takes into account the sublet space. It includes both the direct lease space from landlords as well as sublet space that other tenants may be trying to sublet. So obviously that number is considerably higher at essentially 20%. And that compares to a national vacancy rate of 16.1%. So Washington, D.C. is considerably higher. So having said that, in the fourth quarter, we did see some positive metrics, some positive signs in terms of leasing activity. So we saw in the fourth quarter that the vacancy rate did in fact drop by 20 basis points, which brought us to that 17.1%. In addition to that, over the course of 2024, we saw essentially the highest level of leasing activity that we've seen in 3 years. So we saw 8 million square feet being leased over the course of 2024, the entire year. And then of that 8 million square feet, about 2.2 million square feet was leased in the fourth quarter of this past year. And the biggest contributor to those leases were different government entities. They leased the highest volume of space, followed by law firms, and then businesses and financial service companies, and then nonprofit organizations, which historically has been the pretty traditional mix for the Washington, D.C. area. And then Class A buildings, consistent with some of our comments in past podcasts, Class A or 5-star buildings, they actually captured about 60% of the leasing activity going back as far as like 2020. So over that entire period of time, and now going back to 2020, the Class A or 5-star buildings, 4 and 5-star buildings, have captured about 60% of leasing activity. And that goes back to the trend we've mentioned before of the flight to quality. So looking at 2025 into 2025, what are we expecting? Well, we're expecting continued challenges, unfortunately. And even though we are right now at a record high vacancy rate, we think that vacancy rate's still going to go a little bit higher. And even though the leasing activity, particularly in the fourth quarter, but really over the whole 2024 was strong, there's still spaces coming back to the market quicker than it's being leased up. So looking at the different classes of property, we expect Class A properties to kind of maintain the rental rates, at least the asking rates that are on the market. And inevitably, there's some concessions being given, but again, Class A properties are capturing 60% of the activity for the last several years. So we expect their rental rates to be maintained. In addition to that, there's little to no new construction in terms of office construction in the Washington, D.C. metropolitan area. Looking at the numbers, the larger numbers there, you can see that right now there's 12 properties under construction. Those 12 properties represent just over 2 million square feet. That's less than 0.5% of the total inventory in the market. And of those 12 properties, essentially almost 70% of them are pre-leased. And the ones that are not pre-leased, it takes a long time to get these properties to the market. So they were probably started, pre-COVID, and they just continued on, even though the demand hasn't necessarily been there. So in addition to that, the GSA, General Services Administration, the federal government, is considering canceling about 70 million square feet of leases in the Washington, D.C. metropolitan area. There's a fear that could hurt the privately owned properties. In addition to that, there's also federal government-owned properties that are expected to be brought to market for sale at potentially as much as 70% discounts. And again, that'll put pressure on lower prices of private sector owned properties. We're going to look at some charts now that some graphs that sort of reinforce some of these trends. So this first one is a graph that shows the net absorption, the net deliveries, and the vacancy rates. So the vacancy rates are represented by the lines. We see the U.S. in its entirety in yellow, and then we see the Washington, D.C. market in green with the vacancy rates. So you can see that right around 2024, the end of 2024, beginning of 2025, we're right around that 18%, a little bit less than 18%, but it's expected to tick up to about 18% and then kind of flatline from there for the next few years. And then you can see with the orange bars, which are the deliveries, and then the blue, that's the absorption, and the blue is the deliveries. You can see that with the orange bars going beyond 2024, we're showing negative absorption occurring at least through 2026, 2027. And again, no deliveries reflected by the blue bars. Charles, anything you want to add to that particular graph or thoughts or?
Well, it's interesting. I wonder whether this includes the intention to get rid of all the 70 million square feet of space. We're seeing a lot of negative inventory net deliveries with the fact that those blue lines are a little bit going below. But, it's sort of a scary situation in Washington, D.C. On the good side, we have the new administration trying to bring people back to the office, which if more government people come back to the office, more private sector people will come back to the office. They will just follow them in D.C. So that will be a good thing. But if you're getting rid of all of this inventory, is that a good thing or a bad thing? Does that mean that you're decreasing the workforce and that's an issue? So there's a lot of uncertainty here. And that's what I see in this graph is uncertainty.
Good points. So moving on to the next graph, which is the market asking rents per square foot. The blue lines, the blue line at the top represents Class A or 4 and 5 star properties in the Washington, D.C. metropolitan market. And then down at the bottom in orange, we see 3-star properties. And then the yellow again is the United States overall. And a couple things here. Number one, not surprisingly, there's a big disparity in pricing between the Class A or 5-star properties versus 3-star properties. But the big takeaway, I guess, is really the flatlining of the rental rate. So you can see, we indicated earlier, right around beginning of 2025, right around $48, almost $50 a square foot as far as the rental rate. And there's really no change forecasted for that for the next couple of years. And somewhat similar, although you can see with like the Washington blended overall rate in green trailing up a little bit, but you can see compared to the yellow United States, it's more precipitous in terms of the rise expected over the next couple of years. So moving on, we're going to talk about deliveries and demolitions, some of which we've already touched on. So here in blue, the blue bars show demolitions, orange bars showing the deliveries, black being net deliveries, and just consistent with what we just said, really little to no deliveries coming to the market over the next few years predicted or in place or in the pipeline. And then looking at sales at the next chart, sales are basically non-existent at the end of 2024, moving into 2025. And I think a key takeaway here is most of what is transacted in the way of sales over the last couple of years has been distressed inventory, and there's going to be certainly more of that coming to the market. Looking at cap rates as it relates to those sales, not surprisingly, even though the sales have been limited, but the cap rates have had to come up considerably, and they've come up for a lot of different reasons, one of which is the rise in interest rates, which always contributes to increases in cap rates. Also, just the risk associated with office properties. Investors are demanding higher levels of returns to enter the office market. So, Charles, before we leave the Washington, D.C. market and you pick it up for Denver office, any other thoughts or comments on those charts or the Washington, D.C. office market?
Um, it's interesting how similar DC and Denver are for different reasons. But when you look at both the retail markets and the office markets, they've reacted very similar over the last few years. Also, what is quite striking about DC is that it shows no rent growth from the last 6 years and going forward for 4 years. So they're talking about the possibility of no rent growth over 10 years. That's just astounding.
Brian, how about you? Before Charles jumps into the Denver office market, any thoughts, comments, questions about the Washington, D.C. and extended metropolitan area office market? We may have lost Brian.
Yeah, there he is.
Oh, go ahead. I'm sorry.
Hello, hey. So there's just variations, different products within the whole DC market when it comes to offices. You also kind of wonder if we are really returning 70 million square feet to non-leasable government space. Are those going to be converted into apartments, condos? What's the conversion of those? There's more questions in my mind than there are answers.
Yeah, those are good points. And we've mentioned the Washington, D.C. market actually has led the country in conversion of office properties into multifamily. So certainly, hopefully, that's a trend that will continue and be expanded. And so that's impressive, and I think they're on the right track. And to your point, about different types of office buildings, we do know, all of us here, that medical office buildings in particular have performed well. They continue to perform well. They've been very stable, so we can't sort of throw them into the bathwater of the broader general office market. So those are great points. Charles, why don't you pick it up and talk about the Denver office market?
Oh, very good. It's interesting. Going to the second point here, if you listen to real estate people, they'll talk about how job growth has been slow. Well, number one, Denver has a very low unemployment rate, well below national averages. And because of that, we have a shortage of workers, and that's why job growth has been a little bit on the slow side. So a couple other things that is interesting. The vacancy rate, almost the same as Washington, D.C. And that is, but the vacancy rate in Denver has continued to go up from 16.1% last year to 17.2%. Net absorption is almost what it is in DC, negative 1.6 million square feet in 2024. Now, what we've also seen, and we talked about the last few months, is the average lease size. So there's a lot of deals that are happening out there, but they're 40% smaller than they were at their peak in 2015. So they're seeing fewer tenants looking for space in the market, but it's really, you might see more, but they're looking for smaller space. So it's more in square footage that you're seeing smaller tenants. Asking rents have gone up, but that's deceptive because what we're seeing is that fewer tenants are renewing their leases. They're looking for better deals elsewhere, or they're looking for higher quality space. And they might be going from 20,000 square feet in a class A minus building to 10,000 square feet in a class A plus building. So those tenants, again, they're looking for smaller deals. They're looking for higher quality space because they want to have incentives for their people to come into the office. So you'll see health clubs, you'll see better food, you'll see things like that. Now, steep concessions are the norm right now. And when you have rental rates that are slightly going up, but the tenants are looking for good deals, so they're getting concessions. They're getting concessions in terms of tenant build out and in terms of free rent. As with DC, investor demand for sales are way off from its 5-year average. They're looking for higher cap rates. They're going to be looking for more security if they're going to buy a building. The interesting thing also about Denver is, and in DC, there's a lot of high-tech workers that have the power to say, I want to work from home, and they actually really can. They don't lose a beat from working from home. And so it's full swing here in Colorado. So it might be hard to get these people back into the office. As Chad said earlier, the sublease, we have a lot of sublease space available here, and the rents that you're seeing in sublease space to prime space is really high, meaning that if you're looking at sublease space, the rental rate might be 20% lower than for the prime space, or 25% lower. So it's a real competitor with the Class A prime space. In terms of markets, Cherry Creek remains the strongest local geographic market. If buildings are available there, they get leased. They get leased at the highest prices because of the fabulous amenities that we find in Cherry Creek area. New construction. Well, it's interesting. New construction is very high in Denver. And you think, gosh, given the problems in the marketplace, you wouldn't see this. But the reason why you are is that most of them are build to suit. So companies that want to be here and they're building their own facilities. So most of these properties are pre-leased and will be leased and not contribute to any vacancy. So what do we expect in 2025? Vacancy rate will continue moving up. The Class A buildings in Cherry Creek and Rhino, the other active submarket, will continue to outperform. There's going to be little or no new net absorption. We will probably still see negative absorption. Asking rental rates, we think they're going to start going negative. And it'll be pressure from any new product that comes onto the market, and the fact that vacancy rates are still going down. And eventually these building owners are going to lower their rental rates to try to attract tenants. Also, and this is interesting because we talked about there being concessions. Well, those might be harder to do because with high construction costs and lower net operating income, this could constrain their ability to offer steep concessions, which means that you might have lower leasing activity because of that. We also did some research and looked to see that how much office space does the U.S. government own in the Denver market and in Colorado? Almost 11 million square feet. So the question is, what's going to happen to these spaces with the new administration? So there's uncertainty over there, and that could be a problem. So that's what we're looking for in 2025 to find out exactly what happens with the new administration. In fact, they do want to cut the federal workforce. So this graph all the way at the bottom, I wanted to show you this. This is looking all time at the Denver marketplace. So the lowest vacancy rate we've had for office is 6.63%. The highest vacancy rate we've had is 17.48%. So you can see the vacancy is really nearly at all-time highs. That's why I wanted to include this. This really similar look to the DC market. Look all the way on the left. Those orange bars are net absorption. The blue bars are net deliveries, and you can see there was a lot of positive absorption. Then we went into COVID, it was negative, and it's still been negative all the way across. And so what we think is going to happen in the future is it's going to be a year or two of getting through some of this inventory, and then you're going to see an evening out. Over here, market activity. And this is sort of deceiving because it looks like market activity has just slightly gone down. Well, in the fourth quarter of 2024, we had about 2 million square feet, where at its highest, we've had, leasing activities of 3.5 million square feet. You can see every quarter of 2024, leasing activity came down. I want to go back there. Sorry about that. My bad. Okay. Under construction. So you can see that construction activity, again, has been high. And again, with 1.9 million square feet, Denver is one of the more active markets in the country. But that will be paired off, and a lot of that space is already leased. So, you guys, any thoughts about the Denver market, or any questions or thoughts?
I would just add, Charles, similar to the Washington, D.C. market, the Denver participants are making a concerted effort in terms of doing some conversions to multifamily. They haven't been as successful as the Washington, D.C. market, but they're certainly focused on that, and some are there's somewhere in the works and it's happening. So,
Hey, Chad,
uh,
do you think that's because in the DC market with a lot of these really, really small lots that it's easier to convert some of these buildings that might have smaller floor plates into apartments than it would be in Denver or in other areas where the buildings are a little bit more spread out?
yeah, I would agree with that. This with some older buildings in the Washington D.C. market having smaller floor plates, that definitely makes it easier to do the conversions. Plus, the level of inventory in Washington D.C. is so much greater. And you have so much variation in terms of building types. Inevitably, you're going to find some that are more suitable to do
Right.
those conversions. So we're
Yeah,
going to move on. I'm sorry.
they're finding in DC that some of the larger buildings are a little bit more challenging also to convert into condos or apartments.
Absolutely, absolutely. So we're going to move on to the industrial sector. I'm going to start us off with the Washington D.C. metropolitan area industrial sector, and with comments of Brian, Charles, and Charles talk about Denver. So right now, over the course of the last year, there was 5.5 million square feet of industrial space brought to the market. Over that same past year, we saw net absorption of under a million square feet, right around 787,000 square feet absorbed. The vacancy rate right now is at 6.1%. And over the course of the year, we saw a rise in asking rents of 4.4%. So overall, the industrial market for the Washington, D.C. and extended area finished up on solid footing over the course of the year. The vacancy rate has ticked up to 6.1%, as indicated, and this is above a 3-year historical low of 3.8%. But while the vacancy rate has ticked up 6.1%, really is still still a healthy level as far as the vacancy rate. So the big contributor to the vacancy rate is just the combination of the lack of absorption, lower absorption compared to historical standards, as well as quite a bit of product brought to the market over the last few years. So the 10-year average overall for absorption in any given year has been 5.4 million square feet absorbed. And that equates to about 1,350,000 square feet per quarter. And over the course of the last 3 years, we've seen 19 million square feet total brought to market. And of that 19 million, 5.4 million square feet has been brought to market over the past year. So in terms of the different types of industrial, there's been softness, particularly in the logistics sector. And while there has been softness there, we've seen that offset by a rise in demand for data center space. So looking at 2025, what we're expecting is that the Washington, D.C. market will exceed the national market in terms of rental rate increases. We last year, while we saw a 4.4% increase in the growth of asking rents, we're expecting that to be a little bit less in 2025, but still there's still a positive number in terms of the growth rate. So with the significant inventory that's been brought to the market up to this point right now, there's a considerably less inventory that's going to be brought to market in 2025. And just by way of example, inventory space that's geared specifically towards logistics, that's down about 60% year over year in terms of what's being brought to market, 60% going into 2025 versus a year ago. In addition to that, right now, there is about 12 million square feet total under construction right now, metro-wide. And of that 12 million square feet, 7.6 million square feet of that is data centers. And most all that space is pre-leased as far as the data centers. So it's a big, important part of the market right now, and will continue to grow as well. We're going to switch gears, look at some charts. First one is similar to the last type of products. We're looking at the net absorption and deliveries and vacancy. So we can see that it's expected that the vacancy rate will tick up a little bit more, reflected in the green for the Washington, D.C. and extended metropolitan area, maybe up to 7%, similar with the national market. But looking at the absorption in the orange bars and the deliveries in the blue bars, you can see that they're trailing off going into 2025 and for the next 3 or so years as compared to the last 5 years. Moving on to market asking rents, you can see we've got a steady increase in the asking rents. And we've got the different components, the different industrial types here, flex space being in green, specialized space being in orange, logistics being in blue, and then the US being in black. But regardless, you see the steady increase in the asking rents that's forecasted to continue on in the next few years. So a very strong, very healthy market. Talking about sales for the industrial sector, at the end of 2024, going into 2025, very low level of sales. And that's just because there's strong demand for industrial product, and most of the owners are just holding on to it. Not a lot of sellers out there. That's driving up the pricing, as you can see off to the left in terms of the pricing per square foot. And the overall sales volume, which is in the billions shown on the right, is pretty low. With that, if you guys have anything to add to the industrial sector for Washington, D.C., love to hear it. And then, Charles, you can pick it up with the Denver industrial market.
Office and
could be successful in bringing more industrial activity back to the United States. That's just going to drive up prices even more. Okay. And that's going to impact consumer pricing. So it'll be interesting as to how you mitigate that dual factor. You're going to have more demand for industrial. You're going to have more demand for industrial properties and raw land, right? Bringing up construction costs for that segment. And that's going to get passed on to the consumer. So are we looking at another new part of inflationary reasoning?
No doubt about it. Serious potential for that there.
Yeah, the other side of this is how interesting the DC market is, because it really is a flex and data center market, and that's what's running that market. Whereas in Colorado, it really is logistics which really ran the market, and small warehouse, but it really is the logistics market that really moved it for many years. So it'll be interesting to see what happens in the future. Want me to move on to Denver?
Yeah, go ahead. Pick up on Denver.
All right. Vacancy high, and it's really high because there's been a lot of inventory added to the market. And as you saw with DC, there was a time in DC where the vacancy was at 3.5%, 4%. So what do developers do when they see such low vacancy? They build stuff, and that's what they've done in Denver. So we're at the end of a construction boom. It is ending. We have 4 million square feet under construction, and most of that is going to deliver in the next 6 months. So we're going to burn through that pretty quickly. So we expect rent growth to slow for a little while, but in the second half of the year, we think it's going to pick up as some of this space gets leased and moved through. Net absorption, though positive, is less than what it's been, about 40% of what it's been at its pre-pandemic peak. And again, in 6 months, we expect supply to outpace demand, which is why vacancy rates are going to probably continue up. But then we think it's going to start coming down after 6 months. Construction starts down. We're burning through all the construction because starts are down. With new products still hitting the market, we do expect slower rent growth, but it's going to remain muted. Small bay properties will outperform large bay properties going forward. Small bay properties have not been a big part of the boom because when people build warehouses, they want to build big warehouses. But small bay warehouses are very popular. They lease quickly, more quickly than do large bay warehouses. And especially in Denver, because of lack of new supply, you go to the western part of town and there's almost no vacancy, like 2% warehouse vacancy in the western part of the area. They just aren't there. So because of this, landlords are seeing it and they're much more willing to subdivide bigger spaces into smaller spaces because they think it's going to it's going to lease up much more quickly. Sales, like everything else, down. It's 30% off of their 10-year average. With the rapid increase in interest rates, market fundamentals being slightly weaker, investors are still cautious. We're seeing that nationwide. So what do we expect to see in 2025? Vacancy rates that we said are going to stabilize, go down a little bit at the end of the year as we burn through the new supply hitting the market. Don't expect vacancy to plummet, though. We think it's going to stay that it's going to stay strong. Rental rate growth could go negative in the first 6 months before firming up in the late summer and the fall. We don't think leasing activity is going to grow aggressively. We think it's going to be plodding along a bit. And so we think net absorption will stay at 2024 levels and not a whole lot higher. So the vacancy rate. And just like with DC, we think that this is close to the high point. DC being out more like a year, but we think vacancy will start slowly coming down and hit 6.5%, 7%, which is what you would like it to be. And if you look at the left side of the graph, when vacancies were at 3.5%, 4%, and even 5%, that's where developers are building. And that's what we saw, and that's what pushed up the vacancy rate. Over here, looking at the orange lines, and the orange lines are net absorption. We've had good net absorption. We just don't think it hasn't been great over the last year. We think it will remain steady. The deliveries of new property, you can see how it's going down in 2025, and it'll stay pretty low for the near future. We don't think it's going to get out of whack like it has been. Leasing activity, as we said, it hasn't been exciting. It's been fine, but it hasn't been outlandishly high, and we don't expect it to get outlandishly high in the next year. Any questions before we walk into DC retail?
Washington, D.C. market in Denver is, Washington, D.C. market is just land constricted. Conversely, the Denver extended metropolitan area has a huge amount of available land specifically zoned for industrial. The Denver market is also quicker in terms of the entitlement process, bringing product to the market. So for those reasons, that's why you've seen that excessive inventory. But long term, it's a healthy market in terms of the long term demand there. So I'm gonna go ahead and move into retail. We're gonna close it out with the retail sector, both again for Washington D.C. and then the Denver market. With the retail sector in the Washington D.C. and extended metropolitan market, over the past year, we saw 416,000 square feet brought to market, very negligible amount. Of that amount, we saw 129,000, called 130,000 feet of net absorption. Again, very low amount. And the vacancy rate is extremely low at 4.3%. And the growth in asking rents over the years right around 5%. So very, very strong market from a historical perspective. The availability rate at 4.8% right now is the lowest since 2008. So very, very tight market. The growth in asking rents at 4.9%, that compares to a 10-year average of 2.7%. So again, very strong growth in terms of asking rents. And given the lack of new construction, as we said, the market only absorbed about 130,000 square feet in the past year. And to put that in perspective, looking at a 10-year average, on a 10-year average basis, we usually see right around 1 million square feet being absorbed per year, 960,000 to be specific. The vacancy rate for the Virginia and Maryland suburbs, it stands right around 4% for Virginia, 5% for Maryland, compared to the Washington, D.C. urban core, which is at 9%. And that's largely, that higher vacancy rate is reflective of the softer office market in Washington, D.C. Employees not being out and about, eating, shopping, is contributing to that higher vacancy rate. So in 2024, in terms of construction starts leading into 2025, we're seeing a pipeline of about 1.4 million square feet under construction. And so that'll be helpful in terms of bringing inventory to the market and moderating some of that rent growth and increasing absorption more as well. But still, that represents overall, it represents less than 0.5%, or right around 0.5% of the overall market inventory. And also, pre-pandemic, we were bringing about 2.1 million square feet of space to the market in any given year. Looking at the 2025 forecast for the retail sector, again, we expect strong demand throughout 2025 for retail space with continued limited inventory. That's going to keep pressure on rental rates, having them rise perhaps as much as 10% for the year. The vacancy rate is likely to not go any higher than what it is now, so remaining at a very low level. With the expectation that interest rates will remain stable, maybe moderate, and perhaps some improvement in the economy, this will all continue to feed the retail market in a positive way. The Washington, D.C. in particular has some of the highest per capita or median income amongst residents throughout the Washington, D.C. market. So it's a very strong retail market for those reasons, among other reasons. Getting into our charts and graphs, the first one is the net absorption, net deliveries, and vacancy. As you can see from the bars, the net absorption in orange, the blue, the deliveries, very, very low looking at 2025 and for the next few years. And again, that's just lack of product being brought to market, mainly just the area is land constrained, got higher construction costs, higher interest rates, but the demand is there decent, and what's on the market is performing very well. Looking at the vacancy rates, again, you can see that they're forecasted to continue dropping into 2025, kind of bottoming out a little bit lower in 2026, 2027. So very, very strong market. Moving on, looking at asking rents, similar to what we saw like with the industrial sector, it's a steady climb up as it relates to asking rents for all the different product types. And so for the foreseeable future, we're expecting continued growth there. And then we'll wrap it up with the DC market with the sales sector. Again, similar to the industrial sector, you can see at the end of 2024, moving into 2025, very low levels of sales looking back compared to like the last 5 years. And that is, again, predominantly because most owners are not motivated to sell, and there's a considerable amount of demand out there from buyers. So we see prices holding steady and going up in most cases for retail product. But that low level of sales transactions are expected for the foreseeable future. So any comments, guys, on the retail sector for the Washington, D.C. market before we move into Denver and close it out?
I just find these markets fascinating. I mean, you have very low vacancy, high rent growth, and the fact that sellers are basically saying, you know something, I'm not going to get super high prices here. I'm just going to hold on to these properties is really telling. It just tells that there's so much uncertainty regarding the internet's influence on shopping that it's still out there, and it's going to probably be there for a while.
Mr. Duncan?
I don't have any comments, but I'm getting a lot of text messages from people want to know what's in your glass. I just thought I'd pass it on to you.
That's top secret. I can't comment on that. Don't put me on the spot like that. Mr. Shapiro, pick it up and close us out with the Denver retail sector.
Well, yeah, I said earlier how similar the office and the retail markets are. DC is about 4.3% vacancy. Denver's 3.8%. Availability 5.4%. Limited new construction sounds just like DC. An active consumer base. Solid fundamentals. Rent growth is muted. Now, this is interesting. We would expect that rent growth would be higher. But it's really been low. And we'll talk about that in a second. Leasing activity has been brisk and absorption has been positive. Where there is competition is for well-located pad sites, because that's where you're seeing a little bit of construction is on the build-to-suit pad sites. And so national chains are the biggest movers, and we're seeing restaurants and entertainment tenants are really the most active types of tenants in the marketplace. Retailers are looking also at multifamily properties and the retail space of multifamily properties for really creative ways to build their sales. And we're talking about some very, very, crowded areas in places like Lodo, where there's a lot of apartments and, retailers can do well over there. So what do we expect to happen in 2025? Well, vacancy is going to slowly get tighter. And because of that, we do think rental rates will go up by more. It'll be about more in the 4 or 5% range. I mean, a lot of the space that's out there really isn't high quality space. And that's why the rental rates haven't gone up all that much. It's not the best space. And as I just said earlier, until developers feel more confident in consumers' desire to go to stores, don't expect to see any new developments of large retail centers. And also, what we're talking about in terms of sales, don't expect large sales to be happening around the country. So I love this graph over here because certainly the rental rate line that's blue looks like just what Chad showed us a few seconds ago. And then this is the vacancy rate. And even at the top of the peak there, that's at 5%. That's nothing. And we expect vacancies to stay in that 3.64 to 3.6% range, which means that the expectation is for very little market activity in terms of construction. So when you look at these lines, I want you to look to the left-hand side and see what we're talking about. We're not talking about large spaces. So the first line is 200,000 square feet. So you're not seeing a lot of large construction in any way, and we don't expect to see it going forward. And because of that, we're not going to see a lot of absorption, because if there's not new space, you can't have much new absorption. Leasing activity, slowly working its way down because there's not a whole heck of a lot to lease. So what you're going to end up seeing is pad sites, and many of those are going to be sales. But that might be one part of the market where you start seeing some more activity is properties getting developed and sold, for the triple net numbers. So before we end up, I'm going to hand it back to you, Chad. Anything to say before we say goodbye to everybody?
No, I think that was a great wrap up with the Denver retail sector. So, as always, we really appreciate you joining us for today's podcast and this market update and market forecast. Our contact information is here on the last slide. So if we can be of help to you, please reach out to us. Otherwise, we look forward to you joining us for next month's podcast. Everybody take care.
Take care, everyone.